Pause is the right word. It is, I don't think it's a retreat or reversal. Those are very sharp words. It's just a pause after after like a linear move. This is a combination of what is happening in the global markets. So I think large cap stocks in a sense have hit a pause button largely because of the global narrative where Fed has changed their outlook on the US economy, bond yields have inched higher, and we've seen a smart comeback in the dollar index, which is now north of 105. So to understand that why markets have hit a pause button, that's the data. That broader market have seen a sharper sell-off, Nifty has retreated. I think this is largely got to do with global markets. In the mid and the small cap stocks, I think an overdue correction was a correction was overdue. They had become fat and obese, and I think from some mid-air turbulence, some skim from the top, I think is clearly expected. But my sense is that this is more like a pause. If the correction is going to be there, it's going to be very shallow. Market valuations in large cap stocks are not very expensive. Mid cap stocks, well, they may take some time before they find their feet, but it is nowhere any kind of an indication that the bull market in India is over. Imagine a tree which has some weak fruits, weak leaves, ripe fruits. Yeah. They're just ready to fall. Yeah. And I think this kind of a shakeout will only give good entry points to real genuine investors who've been sitting on the sidelines. So any bull market, all bull markets, they correct, and this kind of a skin from the top I think is very healthy.
And that's exactly what we've been seeing also, right? The way banks are coming off. I mean, the fact that the Nifty Bank is now 140 points away from its 100 DMA. It's stopped twice near that 46,350 odd level, and it's a good 4% away from the highs. And the kind of systematic selling, if I can call it that. It started off with HDFC Bank post its analyst day. Yesterday was ICICI Bank. And I mean, who knows, many others could follow suit, which they already are actually.
See, you can divide banking space into pocket of momentum and pocket of value. I think the pocket of momentum is clearly there in the PSU, mid-tier PSU banking space, where we've talked about it, that how the smaller PSU banks are moving higher like a rising tide phenomenon. But within the large cap banking space, I think not me, just everyone is surprised at why banks are underperforming. You can attribute to the over-ownership, the recent bout of outperformance which happened in 2022. So banks are underperforming. But if there is a pocket where you can say that for next 2, 3, 4 quarters, there is reasonable amount of visibility, some degree of valuation comfort, institutional appetite, and a great bet to really bet on when it comes to India's earnings growth, I think banks really make that cut. So I think the downside in banks will not be very pronounced. The downside in banks would be gobbled up by investors to buy into banks. There are technical aspects which are always at play in the short to the medium term, but if one is looking at a place where there is reasonable amount of comfort, visibility, valuation are on your side, I would say large cap banks for sure. They may have underperformed and they may underperform for next couple of days, who knows, because of liquidity and because of the current leg of decline. But I guess if you want to be a buyer on bad days after a bad patch, it really would be banks. See what may happen, Aisha, if you go below technical levels, the bank Nifty is supposed to be in heavyweight and it may have its impact on the market action purely because of the size it has. But if you're taking a 6-month view or even a 1-year view, I think banks at low levels after the time-wise correction and the valuation of comfort, I think is something you need to rotate your money into, not out of.
Okay, just a quick summary as well as to how the global markets were trending overnight. It was a 3-day losing streak for all the 3 averages, and clearly reacting to the signals from the US Fed Reserve that interest rates could be higher for a longer period of time. Asia, it seems, as well, is piggybacking on that decision, as well as the Bank of Japan rate decision. So barring Hong Kong and Shanghai, everything is in the red. And the GIFT Nifty indicative move as well is down about 0.2%. But let's move on to the other talking point then. And JP Morgan has also said that they will include India in their widely tracked emerging market debt index. And that really, Nikunj, is going to set the stage for billions of dollars of inflows.
See, this in a sense is one of the most anticipated news. Markets knew it was coming. It was, you didn't know when it was coming. There has been a lot of back and forth which has happened within the ministry and within some of the brokerages who wanted certain clarifications. But I think full marks to the government in this case, where they have ensured that whatever concerns were there, those concerns have been addressed, and now JP Morgan has included India as part of their bond portfolio. The implications of this, I think, for the bond market are going to be very profound and very large, simply because it means that at a global level now, because just like MSCI index is used by equity investors for benchmarking purposes, JP Morgan and other indexes are used by the bond investors. India's weightage now could go up to as high as 10%. That means starting from June 2024, we are looking at inflows coming into the Indian bond market. Of course, the concentration would be spread across 8 to 10 months, so it's not going to be having a real impact on the bond market per se, but this is something which now really opens a complete big window of flows into the debt market, more dollars coming into India, and I will not be surprised that this will just add more liquidity to the system. Just think about the setup. If you look at the macros of India, which is the fiscal deficit, the twin deficit, the way the earnings are moving, our forex reserve, the macro concerns in India have got diluted. The yields in India are north of 7%. So really it's one of those, this is something which should have happened earlier, but now it has happened, and this is something which will have profound ramifications, at least on the bond market, both in terms of inflows, liquidity, and option for investors to come into India.
Oh, yeah.